Okay. Hello and welcome to Winner Take All. We're still figuring out the Connecticut studio, but we talk about basically the intersection of large tech monopolies and traditional incumbents. So today we have more coronavirus topics as to be expected. And the first one is to talk about content platforms. Content platforms are businesses like a Facebook, a Google, businesses that are connecting people, consumers to different forms of content, right? And so there's a couple stories out about what Facebook is doing in a good way to help provide a $100 million grant to assist small businesses. So basically what they're doing is saying, hey, here's $100 million for 30,000 small businesses in 30 different nations to give them basically ad inventory. And this is Facebook ad inventory, right? So they're not technically writing a check for $100 million, but they are giving their existing inventory, Facebook ad inventory, valued at $100 million to small businesses so that they can use these ads to continue generating demand and boost their sales. It's a nice gesture, is what I would qualify it as. We're all familiar with TikTok, owned by ByteDance, the largest private tech company in the world. TikTok has been blowing up in the United States. It's a short form video content platform. And what is now announced is that their rival here is now entering the United States. It's YY and Huya, and they own different kind of content platforms, live streaming platforms, game streaming platforms in China and in Asia. And I don't know how you pronounce this. Likee? It's like with two E's. Whatever. They're coming to the United States. I guess they feel like now is a particularly good time to come. We've seen reports that Netflix is agreeing with EU regulators to throttle the quality of the video in Europe to try and keep the bandwidth in Europe functioning, because there's such a huge spike in video consumption in Europe. Similarly, we're seeing things like that in the US as well, but I guess I don't know. We haven't had to go to those degrees to throttle the quality of the video going through our pipes. Nonetheless, Likee has hired 100 people in the United States, half of whom are going to focus on content moderation. I get confused with Bigo and all the different names in here. Whatever. Call it Likee. I don't even know if I'm pronouncing it properly, but whatever. They're coming here. This is a top 10 app in India and other parts of Asia, and now it's coming to the United States. Now, this is a good example, right? If, let's say, Facebook wanted to go to China, Facebook would need to have all of its people based in China. Facebook would also have to comply with all of the Chinese government's rules around content regulation and moderation and all these other things. But this company is coming into the United States. They're hiring 100 people, right? But they have 4,500 people outside of the United States that are actually working in other parts of the business. So it's just another example of showing how the tech protectionism that China set up for particularly, nurturing its tech startup community going back, 10, 20 years now, right? The barrier to entry for, in this case, Chinese tech companies to come into the United States is basically non-existent. They've got 100 people here. Content moderation aren't very high paying jobs, right? I guarantee you the engineering, the product development, all of that is still based over in Asia and not in the US, right? Same thing with TikTok. There are some jobs here, but you don't have anywhere near the level of mandates, protectionism that China puts on US tech companies when trying to enter the Chinese market. You basically have none of that when Chinese companies want to come into the United States. Now, this is a free and open market and so on and so forth and all these other kinds of things. But you do have to ask yourself if we would like a fair playing field on both sides of the spectrum, is a heightened degree of rules and constraints appropriate for Chinese tech companies coming into the United States, just from a wanting a fair playing field standpoint, A. And B, when we understand the fact that pretty much every single tech company that is Chinese is basically an arm of the authoritarian Chinese Communist Party, CCP, and that all of the data in TikTok, there are many security experts that have analyzed the TikTok app that say it's extremely intrusive. It tracks your location and basically sucks all the data off of your phone, a bunch more data than it actually needs to actually serve its purpose of letting you surf short form videos. That's why you've seen the different military and DoD departments ban the ability for sailors in the Navy or Army members to have TikTok on their phones and still connect to the different DoD networks. So all of the data that a Likee, that a TikTok is collecting is going to be at the behest of whatever the Chinese Communist Party would like to do with it. We've covered this story many, many times in the past. So it all goes back to beg the question to say, should we keep no barriers to entry from Chinese tech companies that want to come into the United States? I think it deserves a once over, and I think it deserves some review. Just purely even if you take the national security risks out of the conversation, purely just wanting a fair playing field for U.S. tech companies to be able to go similarly and operate in China, which we all know is basically never going to happen. Last story here on content platforms is this article here, which came out today, looking at the '09 crash. And you can see here the dotted red line is the decline in ad spending on Facebook and Google in the '08-'09 recession. So this is not, again, this isn't the same exact scenario, but you can see here basically at the peak of it, a dip of about 15% decline in ad spending. That's in Q3 of 2019. But for about 3 quarters, Q1, Q2, Q3, 2019, you had a 15% dip. Then you had a spike, a much larger spike in ad spending coming off into 2010, right? So a dip and then a lull and then a spike. So we don't exactly know what the data is on Facebook and Google, but we do know, again, that larger companies, we saw that TikTok is the largest advertiser on Snapchat, ironically enough. Larger companies still have their ad budgets that they can deploy on Facebook and Google. But for smaller businesses, again, where Facebook is providing that $100 million grant for smaller businesses, will smaller businesses still be able to maintain the same level of ad spend on Facebook or Google? I think the answer is no, they won't be. The question is really, how much is that decline attributed to small business? And so we're still trying to figure that out. We still don't know yet, but more to come on that. So the next topic here is around gaming. And we've seen a 75% uptick in gaming usage due to everyone needing to shelter in place and work from home. Video streaming has seen a bump of 12%. This is during peak hours. So that's a Twitch or Microsoft's Mixer platform, the gaming live streaming platforms. YY that we were covering in China also has live game streaming platforms as well. So this data is coming from Verizon, that they see a 75% increase in basically what web traffic is being attributed to and where all of that is going. So that makes sense. You can see here Twitch viewership increased 10%. YouTube gaming went up by 15%. Platform stocks that we have in the gaming space would be something like Zynga. Pretty sure Zynga's stock was, actually all of Platt was up about 4.5% today as compared to QQQ, the NASDAQ 100, which was, I think, around maybe 1.5%. S&P was, I think, up around 2% today. So you saw massive sell-offs the past 2 days, and then you saw a bump going up today in the markets. And interestingly enough, Platt doing quite well against its peer set today. Zynga, an example of a social gaming platform that is in Platt, and I think did better than the average index of 4.5% in today's bounce back. So there's a couple stories here on Amazon. Amazon, we spoke about yesterday, is trying to hire 100,000 people is trying to focus just selling essential items on Amazon. And today we're hearing basically the repercussions of that decision to just focus on really just reserving the fulfillment for essential items are sellers that are saying, hey, I may need to scale back my operations, or I may need to lay off people as a result of not being able to sell my full product catalog. So Amazon sellers are worried their businesses will be hit hard by the company's decision to prioritize shipments of household products and medical supplies. Some sellers who sell products not related to the coronavirus said that the decision forced them to cut costs and furlough employees, while others are bracing for potential layoffs. And they're also saying that some of these merchants have been hit by factories in China not coming back online yet, and so they just don't have product to sell. From Amazon's perspective, Amazon's okay, but there are other repercussions, as you can see from Amazon's actions, just from an economic standpoint, and what other businesses that are dependent upon Amazon and what's going to happen to those. From Amazon, tech monopoly, healthy balance sheet. Generally, over the mid to long term, you're going to see these large tech monopolies with healthy balance sheets actually be able to use these periods to their advantage because they can use the strength of that balance sheet to continue to invest in growth, whereas others may not be able to invest or invest as much, and they'll need to scale back. These tech monopolies are in a great position to continue to double down and continue to spend. Another example of that is Amazon buying the Lord & Taylor building for $1.15 billion. In a time where you may think that real estate buying is definitely going to be scaled back. We've spoken about Zillow stock, Redfin stock taking huge hits over the past few weeks as the real estate markets get thrown into flux. You now see Amazon buying the Lord & Taylor building for $1.15 billion here, saying that this is going to be their New York City headquarters. And they're going to put several thousand employees in the coming years into this building. What was interesting is this building was actually leased by WeWork. And so this was, I thought, a pretty funny line here. The lion's share of the deal consists of Amazon paying off $750 million in construction loans taken out for WeWork's lavish renovation of the space. The remainder consists of $350 million in equity for the building's current owners. This was really paying off debt to pay for what WeWork was going to do to the building, funnily enough, and not as much in equity. But so you see stuff like this. Going deeper into real estate, though, we saw this news from Redfin. So Redfin is temporarily suspending home buying amid the market slump. We have spoken about how Zillow and Redfin, both real estate platforms, have linear activities to buy homes and then resell homes. Buy homes, put it on balance sheet, and then resell the home. Zillow calls it Zillow Offers. Zillow had been aggressively scaling Zillow Offers over the past over 12 months now. They had been taking losses because they were trying to scale this so aggressively. Opendoor is the linear private competitor that Redfin has partnered with on home buying. Looks like Redfin, I didn't even know this, is doing its own home buying in addition to their partnership with Opendoor, interestingly enough. And so yesterday, Redfin said that they're going to suspend the home buying. Definitely the right decision. Real estate prices, as we spoke about yesterday, illiquid investments are going to be hit a lot harder than liquid investments like public equities. Public equities being able to benefit from all of the stimulus, interest rate cuts, and so on and so forth that the federal government and the Fed are able to do to try and stabilize and juice the markets. Illiquid assets are going to bounce back much more slowly, like real estate. So these companies, yes, if you're buying in a handful of the hottest metropolitan markets, those real estate markets are much more fluid and much more liquid. But Zillow, and I don't know the extent of Redfin's program in this, certainly Opendoor, they're buying in 20 or 40 different cities. And so as you go into the tier 2 or possibly tier 3 markets, again, they're going to have less liquidity or a longer timeline for real estate prices to either stabilize or bounce back. A good decision to do this. I think the question is for Zillow, that I think has a much more aggressive program in Zillow Offers. How much inventory, how much real estate does Zillow have on its balance sheet? And, how much of that is underwater right now? That's going to be interesting. One bright spot, though, is I have heard in some tier 2 markets, I have some friends down in Charleston, for example, that still say the real estate markets are progressing strongly. People are wanting to buy homes or refinance homes because you've got 0% interest right now. So there, you do see that, not everything has gone to a standstill. There is still activity here, but at the scale that these platforms are operating is a scale that these companies were rolling out these linear buying and reselling home activities. There's definitely a lot more potential for them to get it wrong and have assets on their balance sheet that are now underwater, especially given that these programs were losing money in the first place. Zillow Offers has continued to lose money quarter over quarter. Just the point is they've been losing less money, but they were still losing money as they were getting to scale and optimizing the business model. So the last point here is around just the trend here about, again, illiquid assets being hurt harder. That includes startups and tech investing. There's another article out here from CB Insights showing what they project to be the decline in private market funding. You can see here, I guess they were expecting it to be around $77 billion in Q1 of 2020. Now they're tranching this down to $67 billion. Now, you got to remember, this has really all come into light in the past few weeks. You still had a pretty much unaffected January and most of February. So this is really looking at, I'd say, the full month of March, maybe the last week of February a little bit, but we're only a few weeks into this. So I think when you look at what Q2 of 2019 was $90 billion. So when you say, what's Q2 of 2020 going to be? And is that decline going to be greater than, say, 10 to 15%, which is what they're roughly predicting for Q1 of 2020. And I would say, absolutely, you're going to see a much bigger decline than 10 to 15% compared to where Q2 of 2020 should have been. From the VCs I've been talking to, they are doing a wholesale strategy reassessment. And I think a lot of VCs are actually going to scale back. They might even trim some of their expenses. Again, these illiquid markets and what valuations are these startups going to be able to command? What startups have a healthy enough balance sheet that they can make it through this? What startups, are going to be heavily impacted by the business? All of these things are being reanalyzed inside of VCs and probably many private equity firms for that matter. So it's not a good situation for tech startups. The last closing note is, if we look at Blue Apron stock. Remember Blue Apron, not a platform, but Blue Apron is at $14 a share. They IPO'd at over $100 a share in 2017. This is the home meal kit delivery company. Here's their past month. They were at $2 a share. Now they're at over $14 a share because everyone is, wanting home deliveries. Now, here's the question. When coronavirus passes, over whatever timeline that may be, 3 months, 6 months, where will Blue Apron's share price go? Will it go back down to $2 a share or $5 a share, or is it going to stay above $10 a share? If you ask me, I think it's going to go back down. But it's interesting to see, again, how this massive wholesale change in behavior, needing to work from home and shelter in place, is fundamentally shifting the spread of dollars, the demand profile, and the fortunes or misfortunes of some of these companies. This one not being a platform company. So more on this tomorrow. Fortunately, the studio is literally where I live now, so I can do this pretty much every day, assuming I can prepare for the show. If you have questions or topics that you would like to discuss or me to research or comment on, chat us, let me know, tweet us, and hope everyone's staying safe, staying healthy, and we will talk to you tomorrow. Thanks for joining us.